Good morning, everybody, and welcome to our employee ownership webinar on broad-based employee share plans. For those of you who don't know me, I'm Mark Bizzotti. I'm a board member of EOA, and by day I'm a partner at Viatno Partners, which is a global tax and immigration advisory business, and I sort of specialise in employee equity arrangements. Before going further, I wanted to do an acknowledgement of country. So I'd like to acknowledge the First Nations people of the various lands on which we're gathered here today. I acknowledge them as the traditional custodians of this beautiful land, and I pay my respects to their elders, both past and present. So for today's session on broad-based employee share plans, I'm joined here by fellow EOA board members, Dheeraj Lalwani and Marie-Louise Check. So I might just briefly turn it over to Dee and Marie-Louise to introduce themselves.
Thank you, Mark. Good morning, everyone. My name is Dheeraj Lalwani. As Mark alluded, I'm a member of the board at Employee Ownership, and I'm the head of employee share plans at Link Market Services. I've been at Link for over 15 years, and have been involved in employee share plans for almost 20 years now. So I look forward to today's session.
Thanks, Dheeraj. I'm Marie-Louise Check. I've been an EOA board member for many years, and I've been a HR reward lead for over 20 years, delivering remuneration practices for Australian companies and multinationals, and particularly delivering share plans and aiming to deliver them efficiently, meeting legislative requirements and maximising employee engagement. So I look forward to talking to you today.
Okay, thank you very much, Dee and Marie-Louise. So today's session, as advertised, is on broad-based employee share plans. And when I think about broad-based employee equity plans, one of the real important contributions that these arrangements can make to society is the access to capital that they provide to employees that would otherwise not have access to such capital. And in a world where the gap between the haves and have-nots is only increasing, these arrangements can make a real impact to lower paid and lower skilled employees. I'm definitely not trying to suggest that these arrangements are the panacea for some of the inequities that exist in our world, but these arrangements definitely can make a small contribution to spread wealth and provide opportunities for employees that may not otherwise have these access to capital afforded to them. And here at the EOA, we really want to promote the use of employee equity arrangements and promote and the broader that we can make those arrangements, without a doubt, the better. In terms of our agenda for the session today, Dee will kick us off by covering a little background on employee share plans in Australia before covering some of the most common types of broad-based employee share plans that we witness here in Australia. I know from the attendee list that we have people with various experience in employee share plans. We do at the EOA use these sessions as an education vehicle for newcomers, so we will briefly cover some basic background and concepts. Marie-Louise will then take us through some guidance on implementing a new scheme and employee engagement. And then I will take us through some of the global tax insights, which are particularly relevant if you're looking to expand your arrangement outside of Australia. We should have plenty of time for questions at the end. So to help with the flow of the session, we might hold off on taking questions until the end. But if you think of any questions, pop them into the chat during the session, and we'll look to circle back to them at the end. One of the final things I just wanted to highlight is that Dee, Marie-Louise, and myself, our experience predominantly relates to listed companies. Broad-based equity arrangements for unlisted companies, particularly those with a larger population of employees, has historically been challenging due to the corporate regulations here in Australia. We have had some recent reforms in the last 12 months that have sought to improve the situation. But I just wanted to highlight that your presenters here today are not as well versed in that space. And so while the content that we provide today will also apply to unlisted companies, we won't be specifically addressing some of the particular challenges or nuances that can exist for unlisted companies. And so with that, I might then turn it over to Dee to kick us off.
Wonderful. Well, thanks for that, Mark, and for the introduction. Good morning, everyone, and welcome to the webinar today. I appreciate everyone being online to listen into the employee share plans landscape in Australia. As Mark alluded, we want to use this as a bit of an education session as well. And I would like to probably just start with a very simple question. What is an employee share plan? In a very simplistic terms, it's an arrangement that allows employees to acquire shares in the employer company. Now, there are various ways of designing those plans. There are a lot of rules and regulations around it, but it's quite important for us to really think about the benefits of an employee share scheme. So from an employee perspective, there are certainly a lot of tangible benefits. The employee receives these shares. There is an increase in the share price. They gain value in those shares. They're able to receive dividends if the company pays dividends. Again, a monetary benefit that an employee receives. There are certain rules within the Corporations Act that allows for tax benefits that employees are also available to the employees as part of an employee share scheme. So those are certainly some really tangible reasons for an employee to participate in a plan. But from a company perspective, there are a number of reasons why they provide employee share plans, and a number of them can be really intangible. Things like increase in productivity, because employees are part of the company. They feel they're a part owner of the company, so that improves productivity, that improves retention, it improves reduction in turnover of staff. All those things are quite critical from a company perspective, as they spend a lot of time in training employees and making sure that they've got the right skills within the business. It also aligns the employees and the shareholder goals to work in the best interest of the organization. So certainly there is a number of reasons why the companies should or provide an employee share scheme, and there are multiple ways of designing those plans. So in Australia, within the listed companies landscape, most companies will have certain kind of an employee share plan in place. If we look at the top ASX 100, 200 organizations, they generally tend to have multiple share schemes in place to cater for employees at various levels. Unlisted companies certainly are able to provide employees with an employee share plan, an ability to be a part owner. And as Mark mentioned previously, there are certainly some challenges around that, especially the ability to actually liquidate or cash out those shares. It's not very easy, or it's dependent on certain events, whether it's trigger events like going to an IPO, or there could be an annual transaction that allows employees to actually sell those shares, such as a buyback or ability to actually sell those shares to other employees. The government has been doing a bit more work on this, including startups. I think in the last 5 to 7 years, we have certainly seen more and more unlisted and startup companies offering equity to their employees. But there is a long way to go if we compare that to what's happening in the listed space. Mark, if you just... So just around the employee share plans, and I thought it would be just good to give a brief information on the key type of plans that are offered in Australia. So if we look at broad-based plans, a gift share plan where a maximum value of $1,000 worth of shares are provided to employees is really popular. It's easy to administer, and it provides all the employees with the same number of shares. There are certain conditions that needs to be fulfilled to make sure that it is a qualifying plan. Things like it needs to be offered to at least 75% of your permanent, full-time, and part-time employee base. The shares that are offered under this plan have a minimum restriction of 3 years. And if you earn over if your taxable income is over $180,000, then you lose the exemption on these shares. But I guess that's a good problem to have. The other plans that are offered in the broad-based all-employee basis is a share purchase plan. So there are a few ways of actually designing those plans, and I will certainly talk more about those plans on next couple of other slides. But before we go to that, I thought it would be good to just talk more about other plans that are offered in Australia. Other plans that are offered in Australia. So if you look at the senior managers or executive level, there's certainly a long-term incentive plan that is put in place. It aligns the company's performance. Generally, there's a condition that's linked to those awards. For example, it could be a total shareholder return or EPA, earning per share, and it's over a longer time frame. So we generally see 3 to 5 year performance period for those awards. They're generally offered as a right to a share or an option instead of an ordinary share, and that is simply due to the fact that there's uncertainty that goes in hand with the fact that they need to meet certain performance conditions. We also see short-term incentive plans being offered to senior managers and executives. It generally is a bit of a look back to the last 12 months and see how the executives have met their personal KPIs. And instead of providing all cash in bonuses or short-term incentive, a portion of that is actually deferred into shares or share rights with a further restriction. It essentially allows the company to make sure that they are able to, whilst their KPIs have been met by the executives, they are able to retain those executives. It is certainly a retention tool, and also allows the companies to make sure that nothing comes out of it in the year or two where the performance may have not actually been met. So a lot of different ways the companies design those short-term incentive plans. A couple of other plans that we see in Australia, not very prevalent, but still there are a few companies that offer that. A loan-funded share plan is a plan where there's an arrangement whereby a company provides employee a loan to acquire shares, and the employee is able to repay that loan via salary deductions or make a lump sum payment over a certain period of time. Employee is able to obviously receive any dividends on those shares, and also at the end of the day be able to acquire shares in the company. Cash settled plans, that's not very common if you're offering a plan to Australian participants, but that is something a lot of the companies look at if they've got a global employee base, and especially if you've got a really small number of employees that are based overseas, it can be quite challenging or complex to actually get all their plan approvals, getting all their documents set up. It's easier in that sense to actually offer them a cash settled plan, which is still linked to the company's share price. So we'll just move to the next slide. Thanks, Mark. So as I said, I just want to talk more in details about a share purchase plan. So we've noted here some of the key features, and it's not necessarily all these features apply to each plan. So the companies do have a flexibility in terms of how they design their share purchase plan. A share purchase plan essentially allows an employee to salary sacrifice a portion of their wages to acquire shares. There are certain requirements within the legislation that needs to be followed by all organizations offering a share purchase plan, that includes things like you need to have a separate account that holds the funds for the share purchase plan. there's an ability for employee to withdraw or discontinue from the plan at any time. And if an employee withdraws from the plan, any residual funds that are still left or haven't been used for a share purchase needs to be returned back to the employee within 45 days. Look, these plans can be pre-tax or post-tax deductions, and I will probably provide a bit more few designs on the next slide. But the reason for these plans is to allow employees to acquire shares in the company, and gives them a really good vehicle to do that. The frequency of purchase, it depends on the company's, the volumes or how many shares are traded. It can be on a monthly basis, quarterly, or you may have a biannual purchase under that plan. But it also means, essentially from a company perspective, you want to have a good spread of share price for employees. So it's not all kind of, at a certain date and a certain time of the year. So it's quite important to really consider the frequency of those purchases. And the restriction period. So there are a few things that companies can certainly use as part of the share purchase plan design. Under the legislation, there is up to 15 years available for a tax-deferred scheme. But most companies actually allow employees to elect certain deduction restriction period. So what we generally see is companies offering, say, 1, 3, 5, 7, 15 years as an option, and an employee can say, okay, I would like to defer my tax over that period. I'll just move to the next slide, which will probably provide a bit more information on how this plan, the share purchase plan designs work. And what I've noted there are the three key or the most popular designs we see across the listed companies. So a tax-exempt share purchase plan allows employees to purchase shares up to a value of $1,000. It's pre-tax. The benefit for the employee is the fact that they're not paying for any brokerage or admin fees, and they're able to acquire shares in the company. The tax-deferred share purchase plan, it allows employees to actually purchase shares up to a maximum of $5,000. It's a tax-deferred, so employee does have to pay tax, but they're deferring the point of when they actually pay tax on the shares. Again, a pre-tax salary deduction. They can purchase a larger number of shares, and they have the ability to actually defer the tax for up to 15 years. And the last one is quite an interesting one, and that's where we see a lot of growth in the last 12 to 24 months are the post-tax share match plans. What we've seen is allowing employees to purchase from a minimum, say, $2,000, and the maximum varying from $5,000 to up to $20,000. So the employees are actually purchasing those shares from their post-tax deduction, and the company is matching that those share purchase employee by a certain ratio. So it can be 1-to-1, or for every 5 shares purchased by employee, company matches that by 1 share, or it could be a greater ratio. This plan certainly provides employees an ability to purchase a larger number of shares and at the same time acquire shares or receive loyalty shares from the company. And over the past few years, where companies have been offering plans like this, have seen a great wealth being built by the employees, and it certainly created a wealth stream for employees. And not to mention they receive dividends on all the shares as well. So certainly, from an employee perspective, it creates a real buzz for them that they're receiving a larger value, and I guess it does obviously have an impact on as I mentioned earlier, the fact that employees productivity goes up, and there's less absenteeism and turnover as well. I'll probably just hand it over to Marie-Louise next to talk more about implementing a new scheme.
Thanks, Diraj. So I'd like to take you through some of the thought processes when your company starts discussing wanting to implement a new share plan. So typically you will form a working group with key stakeholders, which are your HR team, your legal team, your tax team, and then your professional services consultant, because there's so many aspects to implementing a share plan that bringing all the thoughts together is really important. You'll kick off with the scoping of it. And as Diraj was talking about, the company objectives, which are typically rewarding employees, motivating them as part owners, attracting and retaining. And if we think again from a company perspective, it's attracting and retaining, it's aligning the interests of employees with their shareholders, it's increasing loyalty and reducing turnover, hopefully. From an employee perspective, it's an increased sense of ownership, it's increased financial rewards, as we've mentioned, based on company performance, and a long-term savings plan all going well. So that's, your objectives defined, you have to define them. And then the next aspect is to start discussing design and types of plans, as Diraj was detailing. So whether it's exempt or deferred, you typically will want to land on some plan features, for example, share matching. What does that share matching look like? And then really importantly is your targeted employee cohort. Do you want to offer it to professionals? Do you want to offer it to your frontline? Are you going to include only permanent employees? If you include fixed termers, what does that look like? You may want to offer it to contingents. So there's very many considerations about the targeted employee population, and you need to land on that. I think an important rule is the 75% rule. So depending how you're going to land, you need to consider that if it's a salary sacrifice plan, you need to offer it to 75% of your permanent population who have 3 years service. So that's a test you need to conduct. So very important to focus on that. So obviously, once you've gathered your thoughts in the working group, your professional services partner will help you draft the plan rules, the regulations, the conditions, the invitation letter, the tax treatment, the compliance, offer to vesting, and of course the leave elapsing. So there's a lot that goes into it. So start early if possible. And if it is a salary sacrifice plan, it's they'll help you work out and verbalise the mechanics of it to benefit from the exemption. So one of the things that I think, maybe we'll go to the next slide and I'll talk to that. So when you actually have all those considerations, you'll typically want to have a summary document, which might be a scope of work or a key highlights feature document. And importantly, the cost, because your executive team or your board are going to want to know how much it's going to cost, and particularly you're offering it year on year. So you need to do some analysis of what it's going to cost you based on the employee cohort. And hopefully once that's approved, you engage your share registry and the platform you'll be using. Now, you might use a share registry that you already have with existing share plans. I think key to that is, asking share registries if they can deliver it in the time frame that you need, because sometimes we don't leave enough lead time, but that's why I say start early. And once the share registry are engaged, they're going to have a project team, they're going to have a project plan, and it's going to be really important that you monitor time-bound actions. So for example, adhere to the invitation window and source key documentation. So some of the key documentation that you would consider is your key features, terms, conditions, opt-in form, tax summary, and securities dealing. They're sort of your pretty much standard, but also you need to start early and get from your legal team, if for the company to qualify for relief, they need a statement of being solvent, and they need a valuation of shares to be allocated, and historic share price, audited financial statements. So there are many documents you need to gather. So I just wanted to circle back to how other things to consider in the project plan. And one of them is, around privacy. So when you're working with your share registry, you will discuss what you can and can't provide in terms of employee uploads. There are many data points that are easy to provide, but there are sensitive ones, tax file numbers, date of birth, addresses. So you can discuss with your registry team what you're going to provide and what an employee can actually key in themselves once they participate. So you can work through those decision points. And ultimately, the share registry team will help you with the ESS statement or the pre-tax plans. And which leads me to the next slide. We need to agree a communication plan. That is key to the success of any share plan. So we'll go to the next slide. So we're now going to touch on employee engagement. We know that employee share plans help increase employee engagement, and it's important that employees are aware of the benefits to motivate them to participate, which circles back to the importance of a communication plan and how clearly it's articulated, because we know that share plans are very legalistic and they need to be simplified and we use many mechanisms to do that. And ultimately, your eligible employee audience needs to have a good experience. We need to use multi-channels and mediums to reach all types of employees. Checking your eligible employees have company emails. We've been caught out before where we're ready to implement and then we realise our blue collar worker don't have emails or they don't sit at their computer. So you need to have workarounds around that. And key to all this is the launch of a share plan should start with the CEO and, launch email, which tells about the company objectives and a high level summary of what the share plan is about. And obviously you send reminders down the track. Just go to the next slide, please. So as we mentioned, there are the multi-channel communications, and this is a very practical approach at how to engage. There's more ideas than this, but it's just some that I want to take you through. So an obvious one is email, because that's how ultimately people are going to get their invitation. Well, one way they could get their invitation. But if I'm thinking about the blue collar workers and frontline, we typically would put our posters with QR codes because they are able to then walk up to the poster with their phones, scan the QR codes, and it will take them to an environment where there's more information or how to get more information. So that's a really good strategy for your frontline workers. Brochures have been around for a while, electronic or hard copy now. For them, anyone can pick up a brochure and take it home to their families, discuss it with their families. It's a nice, tangible, short, sharp piece of information to kick off the discussion. I think it serves a really good purpose. And the video tutorial, I think, is a pleasant way of learning. We always try and build a video that is relatable, whether it's a cartoon style or, a bit of fun infused into it. So it's not just legal documents staring at you. So I would strongly recommend the video. And toolbox talks seem to work really well for those frontline employees because they typically are hosted by superintendents or managers who blue collar workers would actually relate to, and they deliver very high level information about when the online sessions will be, possibly just very high level, like in the CEO email about the share plans and the type of share plans. And that will, promote engagement with that cohort. For the online sessions, I think what's really important is that you have a variety of sessions, whether it be lunchtime, so people can stop in their lunchtime and participate, before work, after work. So have a good spread of different times when you hold the online sessions. And online sessions are, you might schedule 3, but you have a lot of people who attend those or host those online sessions. You'll have the registry people, you'll have your professional partners, you'll have executives, you'll have HR. So they typically can't keep attending and providing these sessions. So recording them is really key so that after they've finished, you can save that recording and you can have it available at a later point in time. So that's really important. And another key takeaway for us that we learned was to expand our frequently asked questions. So you will already have developed a frequently asked questions document, but as you hold each session, continue to expand on those frequently asked questions so that you gather real questions that employees have asked and they're useful for future offers. And very important to me is a dedicated email for inquiries. So firstly, you should take all your HR team who are going to lead their client groups through the journey of the share plan implementation, so there's no surprises when it's finally implemented. And typically employees go to their HR, so that's one contact point. But even better than that is if they can write a dedicated email to someone who will, timely respond so that they don't miss out participating in the share plan and, be able to answer quickly in real time. So I would strongly recommend that. So I'll probably just end by saying you can't underestimate the importance of a good communication plan. And you want to have a really positive, good employee experience. And hopefully all that helps towards your retention levels ultimately. Thank you. Over to you, Mark.
Okay, thank you very much, Marie-Louise. And so we just come to the final section here of our presentation before we open up for Q&A. And that's looking at global tax considerations, which are really relevant for when you look to expand your arrangement beyond Australian shores, which is obviously pretty common these days. Many companies might sort of start out based here in Australia, but generally looking to expand into other global markets, have employees outside of Australia. And how does the broad-based plan that you implement play out for those employees that are not here in Australia? So I'm going to go through some of the plans that both Dee and Marie-Louise spoke about, and sort of look at the good and the bad and ugly. I know they generally sort of fall into three categories, but I've rather than just go with pros and cons, I then grouped the bad and ugly there together. I wasn't clever enough to think of three categories. But if we look at starting off with the exempt tax plans, that's essentially our $1,000 tax exempt plan, the real kind of base concessional tax plan, broad-based plan that we have here in Australia. And I think on the positive side, it's a benefit of being able to provide effectively $1,000 tax-free to employees. We would all love that limit to be higher. It's probably remained at that rate, I think, since the mid or to late 1990s. But that's where it is at the moment. But it does provide an ability to provide a tax-free benefit to employees. You can, if you use newly issued shares of the company, a company can do that without any cash cost to the company. So they can provide that benefit, $1,000 tax-free, with no cash cost to the company by using newly issued shares. And you also get a statutory tax deduction for this plan. So I know particularly around when COVID hit and everyone thought the world was going to end, and companies were looking at how could we actually look to provide some real cost-effective benefits to our employees. This was something that could fit to some populations of employees within a company, that you could provide a benefit that might be $1,000 tax-free. You could do it with no cash cost to the company, and you could get a tax deduction for it. So that was a pretty good selling benefit to the tax exempt plan. On the negative side, the bad and ugly, these plans, although they work really well in Australia, particularly if you've got that population of employees that are eligible for the $1,000 benefit, which essentially means they need to have taxable income of under $180,000, it translates really poorly outside of Australia. So sometimes we see companies that they set up this plan really popular for Australian employees. They then look to expand to the US, to New Zealand, to anywhere else around the globe, and they don't work so well. Generally, what we'll find is that those plans, those shares that are provided to employees, will be taxed up front without any tax concession. So you don't get that $1,000 benefit. And the way that these plans work is that there's a restriction for 3 years until that's met or the employee leaves employment. So you're getting taxed up front, but yet the shares are still restricted for 3 years. And typically when we go outside of Australia, most companies will employ, most countries operate tax withholding. So the company needs to withhold those taxes at that time. And so, companies almost need to provide employees with, say, $1,000 worth of shares and immediately, take away, a good portion of that benefit in tax. So there's some things to work through around that. Again, it doesn't really translate that well outside of Australia. The next one I want to touch on is the salary sacrifice plan, which I must admit, from my experience as an advisor, don't see as much of. I know there are some companies that do operate it, but from my personal experience, not as popular. I mean, Dee, Murray, Louise may share their experiences of saying it a bit more. I think from one of the real benefits of salary sacrifice here in Australia is that it really increases the purchasing power. That ability to purchase shares with pre-tax dollars rather than post-tax dollars, and that means that you can buy more shares. Hopefully have more shares that can benefit from upside in growth in the share price, more shares that can benefit from the payment of dividends. And through the concessions available here in Australia, you can defer the tax on that acquisition of shares until a latter point in time. On the bad and ugly side, these types of plans also don't really translate that well outside of Australia. Salary sacrifice is almost very much an Australian concept. If you went to the US or to the UK, they don't have that kind of sort of notion that you can salary sacrifice for benefits as we do here in Australia. So generally, it's considered to be upfront a benefit that's typically subject to tax without any concession. I think the other thing around salary sacrifice is that even though from an employee perspective, dealing with looking at some of these plans, it can be a bit confusing for some employees. I think some employees think that I've bought those shares, I've paid for them, and therefore there should be no further tax implications as a result. It's just like buying shares with post-tax dollars. But that's not the case. It's salary sacrifice. You're buying shares with pre-tax dollars. It is a benefit. There are income tax implications, albeit at a later date. So it does require a bit more also, I think, explanation as to around how those plans operate, probably particularly from a tax perspective. Now, the third one I want to touch on was the matching share plan. And this is one of probably the more common broad-based plans that we see global companies implement these days, and one of the real one of the benefits around that is that it really is consistently treated globally. Most countries operate on the same basis. There's shares typically acquired with post-tax monies, no tax implications, free matching shares that are provided at a later date if the employee remains employed, and they're typically taxed when the employee receives those shares. So real sort of consistent treatment, which definitely helps for the communication piece and the understanding. I think from a company perspective, a real benefit is that employees have to sort of pay to play in these types of plans. They need to stump up some of their own cash to purchase some shares to enable them to receive the benefit of these matching shares in the future. And that generally means that employees are really, they're opting into these plans. They recognize the benefit, they value that benefit that the company is providing to them. And then we have flexibility on that matching ratio. Most commonly probably do see 1-to-1. A company will match every share that's purchased by the employee on a 1-for-1 basis, but that doesn't have to be the case. Some companies will match 1 for every 2 that's purchased, and I think I've even seen 1 for every 4. So there is some flexibility around it. In terms of the bad and ugly side, I mean, I've got some question marks, which sort of means I'm actually not too sure if there's a whole lot that's really bad about a share matching plan? I mean, maybe from an employee's perspective, maybe compared to a gift plan, that they're not receiving a free allocation of shares. You know, they're having to pay some of their own money up front to participate. And as a result, I guess you often would see generally lower participation rates in a share matching plan compared to a gift plan where you're giving, say, employees $1,000 worth of shares. You typically then would find it really, you get very high participation rates. Not many people are going to knock back a gift. Whereas these ones here, generally rates are lower because people have to opt in. They've got to pay some of their own money. But again, maybe that can also be seen that they recognise the benefits, they value it. The other one I had there was maybe more complex to administer. Speaking with people, I think, again, when you have any type of broad-based plan, without a doubt, there's a decent amount of administration that's involved. We can't shy away from that. Is there more complexity around having to deduct amounts from people's pay to purchase those shares and then to subsequently match with a gift? But potentially, I think speaking with others, many would say they're relatively sort of on par. And the final one that I really wanted to touch on is a global RSU plan, so a global restricted share unit plan. And this is, often I think RSU plans are kind of more considered around executive type sort of employee equity plans, which are effectively relate to a right to receive a free share in the future if the employee reaches certain conditions. And the base one is that they remain employed for a specified period of time, but you could also have performance conditions related to that. But I think we're increasingly seeing, particularly from a global level, particularly within, I think, the tech industry, that they generally have almost all of their employees participate in their RSU, their restricted stock unit plan. So all employees receive a right to receive a free share, maybe at different values that they're receiving, but depending on their grade, their seniority, maybe their experience. But they're effectively getting a right to receive a free share in the future if they meet those, either typically a service condition. And so these are obviously highly valued by employees, a right to receive, free shares in a company. And another real benefit around them is that they, again, are typically treated really consistently globally. Generally, most employees will be taxable on those RSUs when they actually receive the shares on satisfaction of those vesting conditions. On the negative side around this particular type of plan is generally the cost to the company. Again, it's a right to receive free shares. The company needs to fund that, to provide that benefit to employees, and there's obviously then an associated cost with doing that. Again, thinking about lots of tech companies, you often will see that there's lots of issues of new shares that they use to fund it. So it's not necessarily a direct cash cost to the company. But there still is a cost, I guess, in terms of dilution. In that case, there's an accounting cost in terms of having to expense those awards. So that's, I guess, a real quick high level discussion around the actual global tax considerations of operating broad-based employee equity plans. That's kind of the end of the formal presentation aspect of this presentation. And so hopefully now we can go through to some questions. I have to confess to my fellow presenters that because I was presenting, I wasn't able to actually view the chat functionality there. So I've just been able to go and sort of to see them now. So so feel free, Dee or Marie-Louise, to take up from any of the questions that you may have already seen posted in the chat, or for anyone else who's out there, again, feel free to post something there in the chat, or also feel free, if you like, to come off mute and to ask your question. We'd love to get some engagement with you now around this topic.
There was one question around share plans and blue collars, because obviously they're large in the mining and energy companies, and I can tell you construction as well. And I guess the question was around other industries. So I'm not sure if anyone, maybe Diraj, from your experience, are there those cohorts?
Yeah, absolutely, Marie-Louise. I think when we talk about broad-based employee share plans, it is across all industries. We see in whether it's, I mean, we're not just talking blue collar, but say, in the banking sector, generally large financial institutions provide employees with a broad-based plan. In technology sector as well, so they've got a lot of employees. They are offered gift shares or a broad-based plan ability to purchase shares as well. So it is quite common across industries. The key difference probably is, every company is a bit different. They're in a different cycle of growth versus a mature company. So the design of the plan may differ. The objectives of the company and how they want to align that with the employee benefit may be slightly different. But certainly the plans are, we see plans across all different industries being offered to employees.
Raj, I can read out the next one. With the salary sacrifice, how does the employee benefit? Is it in the form of dividends? And is there a minimum length of time the employee needs to hold shares? So I don't know who wants to go first on that one.
Well, I'm happy to maybe from a tax perspective, and then maybe Dee can, from doing with other companies. So yes, so really the way that the employee benefits is how I sort of summarize it, is almost like the purchasing power, because you're able to, instead of having to purchase your tax with post-tax dollars. So if you think of someone who's at a tax rate of, our top rate tax rate, let's say it's 47%, they get $100, they pay $47 of that in tax, and they can go and buy shares at, with the remaining $53, sorry. Under, say, sacrifice, that $100, that pre-tax, you can actually take and go and purchase shares. So you're able to purchase more shares. And I think the idea is that with those more shares, you'll benefit from, hopefully, increased share price growth on a greater number of shares than would have otherwise been the case if you were purchasing them with post-tax dollars. And because you've got more shares, you'll get more, you'll receive more dividends paid on those shares. The way that the tax works, though, is, again, because they have been purchased pre-tax, that they are still subject to income tax. You will need to pay income tax effectively on that $100 at some later point of time. And the way that our tax legislation works is that if you had bought again a share for $100, you will defer that tax until like a restriction sort of period ends on that salary sacrifice share. Which typically, I think, as Dee mentioned, companies allow employees to elect what that restriction period will be, 1 year, 2 years, 3 years, whatever it may be. At the end of that period, whatever is the value of that share, so if that share still remained worth $100, that will be subject to tax at that point of time. If it had increased to be worth $120, you'll pay income tax on that increased amount, $120. If it had decreased in that time, you'll pay income, say to $80, you'll pay income tax on $80. So that's broadly, again, from I think, operational and tax perspective around those how salary sacrifice plans work. Dee, I don't know if you've got to add something on that.
Well, that's spot on, Mark. And I think the only other thing from an employee perspective is generally the cost to acquire those shares is paid by the employer company. So if you were to buy shares on market, you would pay certain brokerage costs. You have to set up a brokering account as well to actually acquire those shares. Whereas employee share scheme, you don't have to go and set up a separate account, and the company generally pays for any admin and brokerage fees associated with that purchase.
So this one is more if anyone have comments. So estimates are that employee share schemes involve as many as 1 million workers across Australia. There is little data available on the extent of coverage. I mean, comments from us, comments from anyone listening, we would welcome that. I'm not sure if anyone has views or comments on that one.
I think I mean, just looking at from my perspective, I mean, we obviously manage plans for a large number of organizations. So, million is probably not too far from reality. It's probably more than 1 million employees in Australia that participate in an employee share scheme. We do manage. I think it will be really interesting to find out from the tax office, I guess, given that we have to do all the filings by 14th of July to the employees and by 14th of August to the ATO. But if we look at some of our top listed companies like Commonwealth Bank or Westpac, and they're all quite large employers, so they've got hundreds and thousands of employees. So I think that million would be quite an easy achievable number in Australia. It's probably greater than that.
Thanks, John. So the next question, well, there are two questions. One is, what is the typical matching ratio you've seen for matching plans? And does employee participation improve outside Australia in your experience, even if shares are free to the employees in Australia? This Megan's, I find the take up is still less than 100. So her, so I mean, I can tell you some of the plans we've implemented is one-on-one matching or a 25% uplift. So there, it depends how generous the company wants to be. So that's part answer to question one, and I'm sure the other panelists will have a view on that one. Participation around Australia. So yeah, I think it fluctuates overseas, but yeah, I'll draw back to Mark and Biraj on that one.
Okay, thanks, Marie-Louise. I'll jump in. Dee's probably going to have the better on the typical matching ratio. Look, I probably would say, in my experience, as an advisor, I probably would see 1 for 1 as being probably most common. But again, I think Dee will come back to you maybe with some better stats on that. He probably sees a lot more. Participation outside of Australia, I think again, this really sort of, I think, has implications around how well you communicate and also what location you're talking about. So I think when you talk about like locations such as particularly the US, where broad-based employee equity arrangements are really, really common, I think you'll find really, really high uptake. You then might go to some other sort of, to be honest, Asian countries where I maybe find like they're less common and less experience that employees have, and they can be a bit more challenging. So I think the communication strategy that you deploy though then is really, really important around that. And finally, I think just that comment around free shares, and you still find that employee take up is less than 100%. Yeah, I think that does happen. I mean, I think sometimes you can sort of struggle to think why does someone not want a free share, but yeah, it happens. And I think that also goes back to, I think, some sort of confusion as well, and around sort of trying to sort of demystify that for employees. They can sometimes be a bit suspicious as to how this is all going to play out. Dee?
Thanks, Mark. So just around the first point around the ratios, there is no one way or one ratio that fits everyone. So it also links to, if you're designing a plan, it's linking to what's the maximum value that employees are putting in that plan. So if the plan is allowing employee to just put $5,000 from a company perspective, you may go, okay, if we are matching that 5,000 to 5,000, what is the cost to the company? If you're allowing employees to put in $20,000 worth, they can purchase shares, then you certainly need to consider, is that cost effective from a company perspective to match that as 1-to-1 ratio, or is it, we certainly need to consider that. And a lot of companies then go, okay, we'll match 1 share for every 2 shares you purchase, or 1 for every 5 shares you purchase. So there are a lot of different ways to design it. I think the key is that it is a free share that employees are receiving from the company. So, certainly there is a benefit that employee is receiving. So most of the times, I think it will be well received by the employees. In terms of the take-up rate for that plan, we see a gradual uptick year on year. So first year, when you roll out a new plan, you may see a take-up rate of, say, 25-30%. The next year, because the employees have received those shares, they've received the matching component, they're talking to each other, there is a better buzz next time when you offer, and you certainly will see a take-up rate can go 40, 50, 60%. So year on year, you'll see the take-up rate of a share match plan increase. And in terms of free, just to your question around the overseas jurisdiction, I completely agree with Mark. The challenge sometimes is the language barrier, perhaps, or it could also be the perception that because the shares are not listed in their own jurisdiction, it's in an overseas jurisdiction, they may not feel very comfortable. Plus, there are some administrative or requirements in certain jurisdictions where you may perhaps need a broker in that region to actually sell those shares, which is not always easy to find a broker that trades in Australian listed shares. So those are probably some of the, I guess, the roadblocks when it comes to overseas participants not buying into a plan. The other thing is, a big part is the foreign exchange rate fluctuation. So, it all depends, right? So if a few years ago, Australian dollar was higher than US dollars. So now we are trading way lower than that. So little things like that may have an impact on employees' perception on whether they want to participate in that plan or not.
Thanks, Diraj. I might segue to a news question because it's a similar concept. And she's asking, with the $1,000 free shares and salary sacrifice programs not being tax effective in non-Australian countries, what are some of the strategies or options to compensate people in these countries so there's no misalignment globally? So that is definitely a challenge. And my initial thoughts are perhaps a post-tax share match offering instead as an option, but I'll defer to both of you for your opinions.
Yeah, I think with the, again, the $1,000 free shares, so sacrifice, I mean, I have seen some companies try to do some tweaks, none of which I must admit I really love. So people say on the $1,000 share plan, I know that I saw one company change that to have actually like a risk of forfeiture associated with those shares, so they could try to get some tax deferral in some other locations, because that was often a big challenge, because the basis here in Australia is that they're not forfeitable. So I didn't really like that, because that's doing something really different for overseas participants compared to Australian participants. Other ones have looked at cash equivalent, so you make that kind of, I think Dee talked about it at the beginning, like a phantom kind of cash payment equivalent. But again, like that's sort of not sort of providing sort of then equity. It's a cash-based compensation. So look, there's no real sort of nice, neat one. I think probably then going into what Marie-Louise was saying, is that if you are going to do this globally, then it's probably then really thinking about, well, what actually is a plan that works well globally for most of our participants, rather than just working in a particular jurisdiction. I think the complexity on the administration side of having to deal with multiple different plans, you generally don't want. You want to have almost like one plan, one consistent operating model that you need to deal with.
There's two more questions, or one's a comment. So in relation to ESPPSs, I noted it said that on a prior slide, it is in increments of 500. I just wanted to confirm if that slide was just saying that it was what companies generally do rather than actual requirement. I think that might have been your slide, was it, Diraj?
I think that's just an example of what can be designed as a design element. So it could be, it's open to absolutely each individual company. It could be in increments of $100 or $50, or even increments of $1 as well. So certainly it's not a legislative requirement. It all comes down to how easy it is for the company as well to administer. So for example, if an employee decides to contribute $774, how do you actually make that deduction over 12 12 months as compared to if it's a straight $800 or $750.
Thanks, Raj. And the last one is JB providing us the GRG undertook some research on ASX prevalence of plans. So we'll be sure to check that link out. So I really appreciate that input. And I really enjoyed today's session. So I hope everyone else did. So that's the end of the questions.
Thank you.
Yeah, well, thank you, Marie-Louise. Thank you, Dee. Thank you, everyone, for joining. I hope you found that informative, and look forward to you maybe participating in another EOA webinar in the future. Thanks, everyone.
Thanks, everyone.
Thank you.